Welcome back to the last QAV for 2025, TK. It is the 30th of December. We're recording this 12:04 p.m. in Bundaberg in the bedroom I grew up in, and that would make it 1:04 p.m. down in Cape Shank. Tony, you said you've been suffering from the hay fever. Happy Christmas. How was your week off? You went to Healesville, is that right?
I did, yeah. That was good. Busy, but it was nice. I haven't been to Healesville for a long time, and it's a lovely place. And spent a couple of nights there, caught up with lots of friends from all over Australia who came in for a party, played golf. Alex had some of her friends up for a lunch the day before, so yeah, just really nice catch up. Then back to Melbourne. Alex came back to Cape Shank with us to spend Christmas morning with us, and then back up to Melbourne for family lunches and family dinners, and then back here, and then just recovering ever since. Taking it easy.
You've got bad hay fever, you were saying.
Yeah. It's apparently a thing down. I don't know if it's a thing on the Mornington Peninsula or Victoria, but yeah, it's just making it uncomfortable at the moment.
Mm. Well, I've been at the beach. We were just down at the best beach in Australia, Elliot Heads. Got back about half an hour ago, but we were chasing millions of soldier crabs over the sand. Fox was having an absolute field day, picking them up with a tennis racket and watching them scarper around. Soldier crabs are fun to play with. You ever play with soldier crabs when you were a kid?
Yeah, I did. Yep, lots of fun.
They bury themselves so quickly in the sand. Anywho,
What was the name of that beach? Sorry, I didn't quite catch it.
Elliot Heads.
Oh, Elliot Heads. Okay.
It's about 10 minutes from my mother's place. Everyone, when they come up here, they go to Bagara, but Bagara's okay, but Elliot Heads is just. There's never anyone there, despite the fact that there's a big caravan park and a lot of development going on, but it's usually mostly empty, and it's just beautiful, the finest white sand, blue sky, blue water. It's just, it's like something out of a postcard every time we go down there. It's our favourite place. And it was beautiful. We got down there about 9:30 this morning and stayed for a couple of hours, and it was just still, picturesque, amazing.
Lucky are we, hey?
Good early morning swim. Hmm?
How lucky are we?
Yeah! That was Fox. Fox was down there going, Australia's the greatest place in the world. Um, okay, well, let's get into stock markety stuff. I'd like to thank Scott for filling in for you last week. He came on the show, and we had a great chat for an hour or so. So thank you again to Scott, and congratulations on the good year that he's had. And the invitation remains open. Anyone who wants to come on and have a chat. Had nobody apart from Scott volunteer themselves to come on. But we always love to have members come on and talk about what's going on, good, bad, or ugly. It doesn't have to be all blue sky stories. If you've had a rough year, come on and tell us about it. But we've had a great year. I did my weekly QAV Light blog post update yesterday, and it was like insane. For the calendar year, the light portfolio is up 37% versus the index up 11%. So, better than triple market. That's for the calendar year. But if I just go for the last 6 months, because that's when all the growth has happened, the light portfolio is up 27% in the last 6 months versus 4% for the index. It's just been absolutely bonkers 6 months for our portfolios. Um, Let me just bring up Navexa so I can have a look at the other portfolios while I'm at it. Because I think and I know, so there's a collection of large cap and small cap stocks there. If I look at my super portfolio, which is all ASX 300, for the calendar year, it's up 24% versus 10 for the index. And if I just look at this financial year, it's up 15% versus 3% for the index. I mean, if I go over the last, say, 3 years, it's still underperforming because that 2022, 2023 period was an absolute nightmare for my super portfolio. Last 3 years, I'm up 9% versus 13% for the index, so I haven't even caught up. But the last 6 months, I've caught up a lot. The dummy portfolio, if I look this financial year, it's up 20% versus 3. And for the calendar year, it's up 27% versus 10. So, yeah, I assume your portfolio, I know we talked about it a couple of weeks ago, but it's just been a
Oh,
good couple of weeks.
yeah. I haven't checked it recently, but I guess it's still up around 35%.
Yeah,
Yep. No, it's been good.
it's one of those years, right?
It
It's one
is,
of
yeah.
those years we hang out for.
Yeah, and I've been trying to work out why, and perhaps it was because interest rates were cut a couple of times, and you referred back to that bad year, which was when interest rates were rising. So there might be a lesson for that in us going forward, because I wouldn't be. It's more likely interest rates will rise next year in 2026 rather than be cut, but who knows? We'll
Right.
see.
You think that might be something we can factor in? Like, if interest rates are rising, we
Yeah, look, I
use
haven't
it as
been
a signal to someone?
potentially. I haven't been able to work out how to do that yet. You know, last time it happened, I spent time looking at like a 3 point trend line for the index, and it certainly went crossed into a sell signal when interest rates started to rise. So that could be a thing, but I couldn't work out any rules which were beneficial because there were past examples where the index was a sell, but my portfolio still did well, or QAV still did well. So there was no clear
Right.
evidence one way or the other. So it could have just been that was the bad year. It might not have been interest rates related. It could have been related to something else.
Yeah. Well, we know the Ukraine invasion happened that
Hmm.
year and trade wars been going on and all that kind of stuff. Just looking at the stocks that have done the heavy lifting for the light portfolio, WGN up 160%. This is just year to date. GNP up 138%. RRL up 132%. SRG up 113%. And RRL I hold in 3 light portfolios. GNP I hold in 2. PRN up 109%. I hold that in all 4 of the light portfolios. PRU up 85. I hold that in all 4. SHA up 107. That's in 1. ASG is up 88%. It's in 3 portfolios. Like so there's some stocks that really had amazing years. If I go to the dummy portfolio, SRG was up 114% for the year. PRN up 102, 103%. But they do the most of the lifting in the dummy portfolio. The rest of them, PPN only up 30, KOV up 36, SRV up 36. It was SRG and PRN that really were the outperformers by large in the dummy portfolio this year. It wasn't. I mean, the light portfolios are obviously there's 4 of them, so there's 80 odd stocks to have a chance to hit the sort of double bagger thing. If I look at my super PRU up 117, NWH up 81, SSM up 44, PRN up 45, ANZ up 24. So yeah, really only one or two big hitters in my super portfolio for the year, but the light portfolios just had a bigger room of stocks to play with. But some really great performances from some of those. WGN, wow, 160%.
Just
What
wondering.
have you noticed? PRN is the big one for you, I think. Is that right?
Yeah, PRN and Perseus were both big ones for me. When I was pulling together a pulled pork today, I started off sort of trying to do a year in review on stocks, and then pretty quickly landed on the ones that you've called out from as being the best performers for the year. And then I started to look through them and see, what made them the best performers. And I think I found the answer. So we can jump to the pulled pork now if you want, where I go into a bit more detail on what that is, because it's kind of relevant to what you're saying.
Yeah.
Yeah, so the pulled pork today was going to be a review of Parenti, and it still is, but I'll jump off from there to some analysis I did on what made Parenti so good this year. So Parenti has been in my portfolio since September 2024, and I bought it at $1.06, and today it's $2.82. So including dividends, that's 122% CAGR over that period of time, which is a little bit over 12 months, I suppose. And when I bought it, I remember going through the buy list looking for a stock. I was filtering for high yield because I wanted to get a good dividend stream income to supplement my income. And Parenti was kind of good. It was, I think it's about 5.5%, so that's pretty good. At the time, it wasn't scoring above the mortgage rate though, so it was a bit of a fudge to use it. But it was also a bit of a fudge because it was a bit below my ADT cutoff. But I remember at the time I thought, oh, I might put Parenti into the portfolio for a bit of growth, because I think back then it was forecasting to grow EPS by something like 8 or 9 times. 89. Sorry, its score of earnings per share forecast over PE was 8 or 9. So it was quite a high forecast earnings per share growth stock. So I put it in the portfolio, and it's been probably the best performer over that time period. And it's done what I wanted it to do, which was to be a good yielding stock, but get some growth to counteract the other stocks in the portfolio, like ANZ and Super Retail Group, which are both good stocks and have done well, but they're not as their growth profiles aren't as strong as a company like Parenti. So a bit of a recap for the pulled pork part of this. Parenti is a drilling company and a contract miner, and it's also grown by rolling up other drilling companies. So it's a bit of a roll up. It's purchased two other QAV buy list stocks in the last couple of years. The last one was DDH, and it also purchased Swick Drilling, which have both been on the buy list. Both were doing well. So, it gives me confidence that their acquisitions are measured and well thought out and not just going for growth. So they're buying buy list stocks, which is good. And they started life, hasn't always been called Parenti. It started life as a company called Ausdrill, which I've owned in the past and was on my buy list back many years ago prior to QAV. So it's always had a good profile in terms of its operating cash flow and the price you pay for it and things like that. But I hasten to add that it's a drilling company, it's a mining contractor, so it's going to be cyclical, just like a lot of the gold mines are that are in our portfolios as well. And it's the classic company benefiting from the mining boom. So we're buying picks and shovels in the gold rush. They operate in Australia and WA, but also in West Africa, where we have a couple of QAV mining stocks as well. So, you could almost say this is the quintessential QAV stock. It's got strong cash flow, operating cash flow. We can buy it for a reasonable multiple. It's got a good yield. It's been measured in its growth, and it's growing. So it's got a growth profile as well. And that's what I paid attention to when I was looking at what could have contributed to its growth this year. So what I did was I went back to the start of the year and pulled out an old buy list from, I think it was about the 18th of January, sometime around the sort of middle to end of January, because I don't think I had a buy list that I did early in January. But anyway, I used that as my starting point. And Parenti was still on the buy list then, and it had a very high growth over PE ratio. So I then decided to look at stocks from that buy list and rank them by their growth over PE ratio, and then compare them to a benchmark. And the benchmark I used was all the stocks on that buy list. And if you bought and hold the 30 odd stocks, or maybe a little bit more on that buy list from January 2025, they've returned 8.4%. And that's on the basis of buying 1/5 of their ADT. So there is a skew towards some of the large caps, and I think this has been a year where small caps have done better than large caps, so that hasn't helped. But 8.4%, about the index, for the year. So I also then did an analysis on just simply buying $1,000 of each stock, so not weighting them by ADT, but by an equal weighting. And I just also highlight the fact that the buy list doesn't have stocks which have an ADT below 15,000. There are some stocks that would have been included, but I excluded those below 15,000. And doing that, the total buy list returned a healthier 18.7%. So that's more like the sort of double market QAV number that we're used to, and that was for the whole buy list bought evenly. There were some stocks which delisted over the year, like URW. So that was the old International Westfields. So I kept them in the analysis at their delisting price. And I also hasten to add, this was a buy and hold. I didn't worry about commodity trades or 3-point trend line trades or whatever. I just simply took the starting portfolio and then put their current prices against them. So that's the benchmark. If we say it's, what did I say? It was 18.7% for the whole buy list at that time. Excuse me. We're going to have a sip of water here for hay fever reasons. I then went back and looked at that list and ranked them by performance. And the best performing stock was Metals X, MLX, which was up 148%. Then Wagner's, Genus Plus, Parenti, McMahon, and Perseus. And all of those were over 100%. They all had triple-digit returns. And one thing I noticed about all of those was they all had a positive growth over PE score. So this is the forecast earnings per share growth over the PE ratio. In the case of MLX, which was the best performing stock, that score was 16. And QAV listeners will know that we look for a stock which scores above 1.5 to give the score on our buy list. PRN had a score of 8.84. MAH, McMahon's, was 7. So they were all way above our cut-off threshold for scoring stocks for growth over PE. Admittedly, some of the stocks were a bit more muted, so Genus Plus was only 1.75, but still above the threshold. So then I looked at ranking the January buy list by growth over PE to see what that showed. And that showed that the top 20 stocks by growth over PE had a performance of 26% on an ADT weighted basis. But again, if I bought an even amount, the top 20 stocks made 43%. So again, without the sort of skew to large market caps, the small caps were doing really well on that basis. I also thought, well, that's not going to help all listeners, and me included, because I need a large ADT. So of those 20 stocks that I pulled out, which had the highest growth over PE ranking, I took out the 4 stocks which had an ADT above $1 million and bought those evenly, and that returned 50%, so even better results. And that list was Parenti, AMP, Ramilius, and Qantas. And obviously, Qantas and AMP were very large ADT stocks, and they had good performances, but not as good as Parenti and Ramilius. So buying them on an even basis made the return 50%, which was bloody good. A couple of other things to note. A lot of the stocks on the buy list have no forecast earnings per share growth. And that's, as we know, because a lot of the stocks that we look at aren't covered by analysts, and so we don't get an analyst forecast for them, so we can't score them. But if I looked at that group alone, they returned only 8% on an even weighted portfolio basis, and they lost money on an ADT weighted portfolio basis. But the ADT weighted portfolio was dominated by Beach Petroleum, which for some reason didn't have a forecast earnings per share, but was much larger than all the other stocks, because most of the stocks that don't have an analyst forecast are small. They're too small to be covered. So if you took out Beach, the performance improved, and in fact there were some good performers in that group. So stocks like Plenty Group returned 50%. So there's still some things to say about that group of stocks that don't have an analyst forecast. The other thing I looked at then was to see if there was a negative correlation between stocks which had a forecast negative growth in earnings per share. And indeed there was. They forecasted that they fared poorly over the year. So an equal weighted portfolio returned 3.2% for 2025 if they had a negative growth over PE. And the ADT weighted one did a little bit better at 8.5%, but still not great. So at best index for negative growth over PE stocks. So that kind of makes me think that we should up the weighting for growth over PE. I'll need to do some more research on that because it's also possible that this was a year which favoured growth stocks. As I said, there were interest rate cuts this year that often favours growth in the market when people feel like the companies have lower borrowing costs, but they also themselves have perhaps more money to invest because they're paying less in mortgages or whatever. They often tend towards going for higher growth investments. So then I said, well, let's look at the growth stocks in general. So I took the download, which is much bigger than the buy list, and it includes all stocks with positive operating cash flows, sorted them by growth over PE, and took the top 20 of those. And all of those stocks as a group returned 92%. So very, very good. Interestingly enough, that group included 5 QAV stocks, and those 5 QAV stocks alone returned 111%. So even better than the growth stocks by themselves. So I think that makes sense. I think it's often been the case that people will pay up for growth and often overpay for growth. And I think that the QAV discipline of buying value with a growth profile is adding to performance, which is good. But it does need more research on my part. So my hypothesis at this stage is to look at changing the scoring for QAV so that we use the growth over PE as the score in that column and give a real big tailwind to the scores for growth over PE being high, because that's worked this year. But I am going to do some more research because, as I said, this year may be different. It may be the year that small caps shine. It may be the year that interest cuts have favoured growth stocks over other ones. So I'll do some more analysis. I'll also run some paper portfolios to see if if it's occurred in past years and if it occurs going forward. But I think there's something in that based on what Parenti and Perseus and Wagner's and other companies like that have done this year. I think it's something to focus on.
We've got buy lists going back 5 or 6 years now. We could
Correct.
take the first buy list from January for each of those years and do a similar analysis, right?
Correct, yeah. So I only sort of did this analysis this morning and yesterday, so I haven't had a chance to do that, but that's my next step for sure.
Yeah, that'd be fascinating.
And also,
So
to be
growth
fair,
over
to look
PE.
at growth over PE in general and see, what the difference is for QAV stocks. The other interesting thing was on that list of ranked stocks in general, a number of those became QAV stocks during the year, like Fleetwood, for example. So it exhibited growth before it exhibited value and came onto the buy list.
And correct me if I'm wrong here, but isn't PEG Peter Lynch favourite metric?
It is.
Which is
Yep.
sort of the inverse of our growth over PE. But it's
It is.
same thing, but he just does
Correct.
it the other way around.
Yeah.
Yeah, right.
Mm.
That was, from memory, one of the things that he always used as a key metric to look at.
Very much so, yeah. And that's why I put it in the buy list, but it looks like it's having an outsized effect, which we're not taking into account. So I'll do some more research on that.
Okay, fascinating.
Mm.
And WGN, Wagner's group, their construction, from memory.
They are.
Did you notice anything about them? They were the number one performer in the like portfolio.
Yeah.
Anything about their
They had a high growth over PE.
growth over P?
Yep,
Yeah.
it was high. And the good thing about that was that they're not a mining stock. So they started as a cement hauler in Toowoomba. That's still a large part of their business. And now they're branching off into making composites out of recycled materials and using it for constructing bridges and shelters and things like that.
Right.
So it's not. I wanted to be very careful. This wasn't just a mining related thing because Parenti was a mining services company. Ramelius is a gold stock. But when you see other stocks on there like Wagner's, it gives me a bit more comfort that it's a growth over PE thing in general.
Yeah.
And Fleetwood too. Fleetwood's a builder.
Yeah. Very interesting, TK.
Mm.
Thank you for doing that. So is that your pulled pork?
It is, yeah. A
It's growth
revisit
over
on
PE
parenting.
pulled pork.
Yes.
All right. Well, let me get back into the news. Just talking about getting back to markets, I saw a chart this morning looking at world stocks in 2025. It's been bonkers all over the world this year, global equities. The Europe stocks, STOXX 600, up 16.6%. The S&P 500 in the US up 17.3 for the year. The FTSE in the UK up 21.5. Hong Kong's index is up 28.8 and Japan's index is up 34.6% for the year. Done absolutely no analysis on why Hong Kong and Japan are doing so well, but do you have any insights?
Sure about Hong Kong, but Japan, if you recall, was a hunting ground for Charlie and Warren a couple of years ago. So they're doing very well out of their analysis on
Hmm.
Japan. A couple of things I've noticed about Japan this year is that for a long time they were in a deflationary cycle and they're now starting to come out of that. So that will be helping. And during that deflationary cycle, there was a lot of focus by Japanese companies on just staying in business. So there are a lot of cross shareholdings, there are a lot of loans, interconnected loans. A lot of businesses will play it safe and not invest a whole heap of money into capital. And that's now changing from what I'm hearing. I spoke to someone who went to a presentation by the Japanese equivalent of the ASX CEO, and he was saying that he's doing as much as he can to convince Japanese companies that it's a growth era now and they should be investing in themselves and in their own businesses more. So just a question on that graph you shared with me. So US S&P is up 17.3%. So when
It
we do our
says,
US show, don't we report a higher
hmm.
number for the US than that?
No, I've got my US portfolio open in front of me. For the last 1 year, it says S&P is up 15.66%.
Okay.
If I do year to date, that's 17.8, about the
Yeah,
same as that
okay.
other chart.
Yeah, right.
Yeah.
No, that's interesting. I know that's the top 500 companies in the US, so maybe it
Hmm.
dilutes the effect of the Magnificent Seven, but I would have thought the US was doing better than that.
Yeah, well, I think the Mag 7, you know, obviously the outperformers over there, and the rest of them are pulling it down.
Yeah, you're right.
Hmm.
Yeah. No, interesting. Interesting that
Hmm.
Japan and China are doing the best, or the Hong Kong index is doing the best. Yeah.
Hmm. Hmm. Other things I've got on the news. This is a week or so old, but Woodside CEO Meg O'Neill is leaving to become the CEO of BP.
Mm.
Apparently, it's happening in April, so a bit of a long transition period there. I haven't had a look at what's happened to Woodside's share price since that was
I think it
announced,
became
but
a
I'm pulling it
sell.
up now. Did it?
Mm.
Seriously? Oh, it dropped down. Yeah.
Yeah. Well, she was highly regarded. And I guess that's why she got the top job at BP, which is a bigger company than Woodside.
Mm.
She's done a lot of good for Woodside. They acquired the BHP oil and gas assets under her watch. They have invested heavily in the US under her watch.
Hmm.
So she's done a lot of good things. I know she also came out with a lot of frustrations about the approval processes in Australia, about how the environmental red tape was meaning it would take 4 or 5 years to get new investment up in Australia compared to other parts of the world. So it's a
Mm.
shame, but look, it's chances are this is a normal career progression for her to do a good job in a smaller company and then move up to run a bigger company. But it's a shame if we
Mm.
lose talent like her to a large cap Australian company because of the regulatory environment in Australia.
Mm.
And look, I accept that you've got to have environmental regulations. I know there's been a review of them recently. Whether that works out for the better or not, I don't know. But it's hard getting the balance right. But yeah, it's got to be good for both investment, which is good for Australia, and the environment, which is good for Australia. So I'm not sure the balance is right at the moment.
Hmm. Well, yes, getting the balance right is difficult in lots of things. I've been doing a lot of deep dive analysis on the housing crisis situation, trying to figure out, what the path forward for that might look like over the last couple of weeks, and trying to get the balance right there is proving to be difficult in lots of places, but, including here at the moment.
I think it's easy.
Do you?
Yeah.
What's the solution?
Well, I'll take you back a couple of days from your drive from Brisbane to Bundaberg. How much empty space did you drive through along the Bruce Highway?
Lots.
Yeah. So why isn't there
All empty
housing?
space. Well, that's part of the problem. I mean, you've got to get the infrastructure built to, provide for people. So you need to have water and electricity and sanitation and shopping and education, and you need to invest in all of those things and have platforms for those.
How much of
But
that?
also, I
And how
think
much of that are we doing?
none.
Yeah.
No. Yeah, none of that. But also, we can build up in the places where we do have those things. We can start to build walk up size 4 to 6 stories a lot more in parts of Australia where we already have all of that infrastructure. But we don't want to do that. We have NIMBY situations everywhere, and we have people with vested interests where they don't want mid-level high-rises going up.
Mm-hmm. And
But that's what...
I have some sympathy for that.
Do you?
Yeah. Well, if I buy a house somewhere, and someone 10 years later, 20 years later, buys a place next door and puts a nightclub in, and they play loud music all night, I've got a right to say, turn it down.
We're not talking about a nightclub. We're talking about residential accommodation.
And if you build a 10-story apartment block next to me, after I've been there living quietly for 20 years, I've got a right to say, fuck off.
Do you?
Absolutely. I bought into one thing, and now it's being changed.
You thought nothing was going to change? You bought in thinking everything was going to stay the same forever, like nothing ever changes?
Not at all. But
okay, well, calm down. Things change.
I'm a confirmed NIMBY. Things do change, and I accept that. But I don't like the anti-NIMBY bash that goes on, because imposing something from outside.
Bash.
Haven't you heard that?
That's my favourite. That's my favourite New Year's Eve party. That's what I'm going to, is the anti-NIMBY bash for New Year's Eve.
Again, there's got to be a balance.
Look, things.
Yeah,
that's what I'm saying. There has to be a balance. Look, I respect that people who bought something thinking nothing was going to change are going to be upset and blah 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 blah. But the flip side is, we have serious problems. We have cost of living issues that are going to affect generations of Australians, and we need to do something different. So, yeah.
Well, but again, I come back to, you drive an hour out of like I drive between here and Melbourne, which is a little over an hour. There's so many what I'll call superannuation farms along the way. Someone's bought 10 acres, and they've been sitting on it.
I don't think anything's ever going to change.
Yeah, well, true, but you're not affecting them really, because they don't live there if you do subdivide their lot. But
they don't get to cry NIMBY.
No, they can if they like.
Oh, okay. Yeah, well, I totally agree with you.
I think any local area should have a big say in what happens to their local area. So it's got to be.
They should have a say, but not the only say.
They should have a say. They should have a big say in it.
Yeah. Well, they should have a say. But you live in a society, and we have to balance the needs and interests of everyone in the society. That's part of the social contract.
Yeah, but it's
probably a lot of politicians are NIMBYs though too. I think that's part of the issue,
Yeah.
and the people funding their campaigns.
Even bigger than that, most of the politicians in Canberra own 3 or 4 houses themselves. So,
well, that's what I'm saying. Yeah. They've got deeply vested interests.
Yeah.
But
no,
yeah,
I firmly think
there's lots of land.
You couldn't drive the way we do in Australia and Europe and not see rows of, as you say, 2 or 3 story terraced housing.
And even in the US, like I've driven cross country the US quite a few times, and like there's a lot of farms and there's a lot of stuff, but the bush even here in Bundaberg. Like I'm driving around I go to Elliot Heads from my mum's place, which, as I said, is a 10-minute drive. 90% of that is just open land. There's some farms, but there's also just a lot of scrub, empty
Correct.
scrub.
Yeah.
Just, could fit 250,000 people
Yep.
between here and just one road down to Elliot Heads.
Yeah.
In a year, if China was running things.
Yeah.
I did a lot of comparison with GPT-2, talking about how's China actually able to build stuff so quickly and we can't build stuff quickly here. And it was like, well, it's the benefit of having an autocratic government that just says,
Yeah.
go build shit.
Well, that's it. You talk to developers and they'll say, yeah, we'd love to take that land outside of Bundaberg and turn it into a nice urban development, but we can't because of the red tape.
There is urban development going on down at Elliot Heads, but it's been going on for 6 years. New estate coming soon. And they've
Yeah.
cleared the land and stuff, but I don't see
And
anything going up there.
I bet you if you research that they wanted to build it and they've been held up with council and state approvals ever since.
Environmental red
Yeah.
tape and all that kind of stuff, which is all
Yeah.
good. But yeah, that's what I was saying. Started this whole thing. There are complexities in doing stuff. Anyway, where were we? Yeah, Meg O'Neill, Woodside, etc. Good. Scott sent me this article. Chair bought $11 million worth of shares days after takeover approach. This is in the Financial Review, December 24th. One of Hum Group's largest shareholders has accused its board of all but ignoring red flags for insider trading when allowing Chairman Andrew Abercrombie to purchase nearly $11 million in shares at a time when the buy now, pay later company was considering a takeover proposal. Raper Capital founder, unfortunately named Jeremy Raper, said the share sales from December 17th to 19th were highly unusual and possibly unheard of, given Abercrombie's acquisition of 15 million shares equaled about 3% of Hum's equity just days after it received the buyout proposal from rival Credit Corp. Well, that's the first piece of news, is that there's a buyout offer from Credit Corp for
Yeah.
Hum. Two companies that have been on our buy list a lot over the years. But what do you think about this chairman buying 15 million shares? Tony, does that strike you as highly unusual?
Oh, I think it's unusual. I don't think it's illegal. So, as the article says, Mr. Abercrombie, started buying after Hum announced the Credit Corp takeover, and then he bought on market for a couple of days. So, unless there was something they didn't disclose, which we'll eventually find out, then he did the right thing. He declared a takeover offer and then bought on market, knowing that the share price would probably go up towards the takeover price. So it's unusual. Normally, if there's an announcement of a takeover offer, senior management don't buy or sell because they are in the middle of those takeover talks. But I don't think there's anything illegal in doing it. So it's it's I think it's fine under the letter of the law. It looks a bit strange if you're looking at it from an investor point of view, but it's also perhaps a signal that yes, Abercrombie thinks the company's undervalued. He did launch his own takeover offer on the company during the year, which was lower than the Credit Corp offer, and that was knocked back. It's been a funny year for Hum. So it's on the buy list at the moment. It's people may recall it. It's a buy now, pay later company, but it's also a company that does a lot of in-store purchasing financing. So, I don't know if it still does. It used to do the Coles credit card when I was working at Coles. I think. Well, that might have been Latitude, similar sort of company. Anyway, it does those kinds of buy now, pay nothing for 5-year type interest rate deals that Harvey Norman and department stores do from time to time. So that's its business. And as I said, there was actually a takeover offer for it by Latitude, which was knocked back. And then the share price tanked. And then Mr. Abercrombie, who's the major shareholder, and I think the founder from memory, he made an offer which was knocked back. And then the accounts were delayed. And there were some questions about, I think it was the carrying value of software in the accounts, which were finally released. And then earlier in December, the CFO resigned. So it's been kind of limping to the finish line for this company in the last couple of months. Then the interesting thing about, which I find even more interesting, is that the offer from Credit Corp came a month before it was announced. So it came
Yeah.
late November, and then they announced it in December. And as Mr. Raper points out, they announced at the same time that they announced his motion to spill half the board. So, um, I mean, I think his insinuation is that they're only announcing it now to look good, to counteract my motion to hold a special meeting and spill the board. So, don't know if that's true or not. Um, Again, I don't think it's illegal to delay announcing the takeover, because what happens in these situations is, and if you read the fine print of the Credit Corp offer, it's talking about it being unconditional and needing to look at the books first, gain due diligence, etc., etc. So, oftentimes, if a company receives such an unconditional, or sorry, such a highly conditional offer, they'll they'll talk to the company which is targeting them and try and beat out something more definitive to take to the market. And sometimes, in the past, there's been cases where a board hasn't made the fact that there was an approach made, because the board felt like it was never going to go ahead, only to be castigated by the shareholders for not being transparent and saying that there was market interest. So it's a bit of a fine line here. The way I would like to see it happen is that Hum should have announced the day that they received the offer from Credit Corp, that they received an offer, even though it was highly conditional and required due diligence, etc., etc. At least the market's fully informed. And it would probably, if there was someone else looking at the company, flush out a competing offer, which is a good thing. So perhaps Hum did that behind the scenes, and its brokers were working furiously to see if there was another offer or not. We don't know. Anyway, it's all out in the public now, and the Hum share price today was a couple of cents lower than the Credit Corp offer. And the Credit Corp offer is in two stages. One is, I think from memory, it's 77 cents a share if they can get the board to agree to a scheme of arrangement, which is an easier way of making a takeover than going hostile on market. But if they can't get that, then Credit Corp have said, providing they get access to the books and do due diligence and are happy with what they find, they'll offer 72 cents a share on market, and until they get the majority of shares to sell into that bid. And I think the share price is about 69 cents. So the market's kind of saying, we think it'll go ahead, but we're not 100% sure it'll go ahead. And because of all the hiccups with the release of the latest results and the fact the CFO resigned, I think it's very fair of Credit Corp to say, hey, we need to look at the books ourselves before we can firm up our offer. So it's very much in a state of flux. I don't think anything illegal has happened in my reading of it, but it's certainly a bit unusual.
Well, we don't hold either Credit Corp or Hum in any of our portfolios. And then neither of them are on the buy list this week, as far as
Oh,
I can
okay.
tell. I just had
Sorry,
a quick look, so
I thought Hum was Hum. So
don't think so.
when I do my buy list, I include the holds. So it's probably got a QAV score, but it's not across its buy line. Let me just have a look at my buy list.
I
Not that it
looked at the
matters.
dummy. No. Yeah, I think it's a Josephine.
Yeah,
I just brought it up a second ago. Yeah, it's still a Josephine. It's not above its byline.
yeah. But actually,
Well, that's
so
all.
I include the
Hmm.
Josephines on mine, and Hum has a very high QAV score at the moment of, let me get to it. It is 0.47 on the buy list,
Hmm.
on my buy list.
Wow.
Mm.
Hmm. I'm reading a book on crowd psychology at the moment that I got tipped off from a Bond novel. One of the most interesting things about reading these Bond novels is he sprinkles in references of stuff that obviously he found interesting. And I'll go,
Yep.
oh, that's interesting. What's that? Mr. Big in Live and Let Die says something to Bond when he's torturing him at one point about some crowd psychology reference that I'm sure you're aware of. We've both read it. And I was like, I've never heard of this one before. So I dug it up to read it. And yeah, it's interesting. But I was thinking about our sentiment score as part of while I was reading that. Like, it's my take on it is, even if we think the numbers look good and the company's performing well and it hits all of our metrics, it's a good quality company and it's undervalued, etc., etc. We respect the crowd psychology behind and
Oh
not
yeah.
buying in. If the crowd is against it for some reason,
Mm.
we're not going to fight the crowd psychology. As much as we might believe in the thesis of the company, we're just going to wait until the crowd psychology turns around, because you could be fighting the crowd for a long time, right?
Correct. And it's possible that our analysis hasn't picked up on the thing which the rest of the market knows. Um,
Yes.
and it's possible that the rest of the market don't, like analysts don't cover the stock, so the rest of the market will never know about this stock and therefore will never buy it off us. So, yeah, the game isn't so much, the game is analysing companies, but the game is also selling them. And you've got to have a liquid market to sell into.
Yeah, good point. Well, that's all the news I have. You got anything else, TK?
No, you covered up those two things. I was going to talk about Meg and the Credit Corp takeover. So that's me.
After Hours. I've been watching Alien Earth
Yeah,
still. It's the only thing I'm really watching at the moment. Loving it.
it's
Love it.
great,
Like,
isn't it?
surprisingly, how
Mm,
much I'm loving it. And loving Timothy Oliphant's character,
mm.
Kirsch, in it as it goes on. He becomes more and more interesting. And Boy Cavalier. But the actor who plays Boy Cavalier has to be the next Doctor. I don't know who that guy is,
Ah,
but
yeah, right.
he'd make such a good
He would.
Doctor if they ever make any more Doctor Who. It's up in the air at the moment, I think. And Adrian Edmondson gets more to
Yeah.
do as the show goes on. Still not a lot, but he's great in
Hmm.
his role as a conciliary. Yeah, but yeah, no, I'm really enjoying all the storylines, including how intelligent the eyeball alien seems to be. Although there was
Yes.
one stupid point I saw when the Boy Cavalier is trying to communicate with the sheep with the eyeball, and he writes 3.14 on his hand and then says, "What's the next number?" I'm like, how's it going to go? How's it going to understand Arabic numerals? I mean, that's a human number
Yeah,
system.
right.
How is some alien going to know what a 3.14 on a human hand looks like? I mean, anyway, outside of that,
I thought that was
yeah,
clever
pretty
though.
good.
How he, you know, the boy Cavalier thought if it's smart enough to know what pi is, it's an intelligent eyeball.
Sure, I like the
Mm,
premise, but how does
mm,
it recognize
yeah.
the numbers? He could have banged it out and see if it recognized the sequence of 3.14159, etc., etc. Anyway, no, good show. Have you watched The Lowdown?
No.
Good show. Also on Disney, I think. Stars Ethan Hawke, and
Oh, I
it's
saw the first episode. Yeah.
right. It's written and directed by the guy who did Reservation Dogs, which we enjoyed, which was a series about a bunch of teenagers on an Indian reservation.
Mhm.
Yeah, so we've been enjoying that. It's kind of a bit of a Elmore Leonardy type
Mm.
thing, set in Tulsa. Yeah, it's kind of cool.
Yeah. Thomas
What
Pynchon type thing.
else?
Yeah.
Yeah, yeah. Reading Bond. I'm up to Moonraker now. Really enjoyed Live and Let Die. It had a lot more pace to it than Casino Royale. Yeah, so
What's your
into
favourite so
Moonraker.
far?
Well, I've only read the first two, so Live and
Oh,
Let
okay.
Die would be my favourite out of those two. But yeah,
Okay.
um, yeah. Reading a book by an historian on Russia, Ukraine, and the US called "The Defeat of the West," talking about how the West is going to suffer defeat at the hands of Russia over Ukraine, and that it was predictable all along. As John Mearsheimer said back in early 2022, he predicted that Russia would win, the West would give up, on Ukraine eventually. Because as he said, for Russia, Ukraine and NATO is an existential threat. For the West, Ukraine is a side project. It's incremental gains. It's not an existential threat. We'll wave banners and give speeches and throw money at it for a little while, but eventually we'll get tired of the whole thing and give up. But Russia isn't going to give up because they remember World War II and World War One and what happens when you have enemies on the border, and they're not going to let that happen again. So, yeah, reading some more stuff about that. Crowd psychology. Yeah,
So there
and
was a
mostly just enjoying the beach.
I saw there was a documentary on Ed Hirsch came up on
Seymour
Netflix.
Hirsch.
Seymour Hirsch, sorry, yes.
Yeah, one of my
Haven't seen
listeners sent me an email yesterday and mentioned that. I haven't had a look at it yet, but I'm a huge fan of Cy Hirsch's work over the last 60 years or 70 years, whatever it's been since the My Lai massacre reveal that he did in the 60s. 60 years, I guess. Yeah. Have you seen it?
I haven't. No, it just popped up on my feed yesterday, so I'm looking forward to watching it. No, we're up to season 4 of The Expanse, which we're loving.
What's that on again? I tried looking for it.
Amazon.
What are you watching it on? Is it? Oh, right. Okay. One I don't have.
Yeah.
Yeah. Well, you got further than I did. I think I only got into like season 2 or something. It gets better. I heard it gets better.
Yeah, about the same. I wouldn't say it gets better or worse, but about the same.
Right. Okay.
Yeah, we're enjoying it. And apparently they're going to make another series by the same author.
Okay.
Because The Expanse has been so popular. Yeah, so that's coming out next year, which I'm looking forward to.
Well, interestingly, the pulled pork I'm going to do in our US show next is AMC AMC Networks, not the cinema chain, but the networks. And, it's been interesting to drill down into their backstory, going right back to the Playboy channel. But also, they AMC had all of these groundbreaking shows, Mad Men, Breaking Bad, Better Call Saul, The Walking Dead, and now they don't have any of those defining shows. And why? What happened between sort of 2007 and 2025 to the economics of cable, which I don't really understand, even though I've read whatever that Raging Tiger's sequel book was about the TV things, because we didn't have cable here. It's kind of the economics of cable is still a little bit of a vague mystery to me.
We have Foxtel.
Foxtel?
Yeah.
Yeah, well, it's not the same thing, but yeah.
Optus Vision. And we had a third one for a while too. Used to be on a satellite feed.
Right.
Yeah. But
not like they did in the US, though. It was a very different ball game over there, the cable thing.
Yeah, I think it's pretty similar. Really. Yeah? Well, if Toronto was any comparison, it was fairly similar to Australia. Right. More channels. I mean, there was 200 plus channels on the Rogers cable TV offering in Toronto.
Right.
And it's a bigger market, so you expect that. But yeah, I think cable's struggling. I mean, I don't think Foxtel's going to stay around much longer in Australia either.
Yeah, well, what I've been learning is, Netflix came along and just sort of disintermediated the whole cable thing, and people are like, why am I paying $100 a month for cable when I don't watch any of the shows? And AMC was making money off of just having their shows licensed on cable networks, and when people cut the cord, as they call it over there, AMC loses those viewers and loses the ad revenue and can't afford to make Mad Men 2 or Breaking Bad 2. I like that Pluribus is finished. We finished the Pluribus thing. That's had its full run. And interestingly, that Vince Gilligan made that with Apple and not with AMC, where he made Breaking Bad and Better Call Saul, because they got more money to throw around. So now it's the guys with the deep pockets. Anyway, we'll get into that next. You got anything else after hours wise? Horses, golf?
Not really. Been taking it easy over the Christmas weekend, which was nice. Read a Matthew Riley page turner called The Detective, which was good. Kind of turn your brain off, and read it in one sitting, which was nice. Kind of like a John Grisham thriller, but got a bit of a soft spot for Matthew Riley being a successful Australian commercial author, so that was good. I'm about to start a book by a guy called Ed Zwick, which I just arrived this
I
morning,
know
which I'm
that
looking
name.
forward to. Yeah, it's called Hits, Flops, and Other Illusions, about his life in Hollywood. So Hollywood director back in the 80s. And I bought it because like the all the blurbs are by people saying this is the next Easy Rider Raging Bull book about Hollywood.
Huh.
Yeah.
Ed Edward Zwick, 30 something.
Made movies like Glory, Courage Under Fire, 30 something, a TV show.
Right. You never watched The Wire, did you? You weren't really into The
What's the
Wire.
first
Oh,
season
you
of
made
it?
Shakespeare in Love. Hmm. One of the actors who was a major cast member in the second season took his own life last week, which was sad. He was quite young. What else? Hollywood news. See, Bridget Bardot died.
I did, yeah.
She, she had an interesting life.
She had.
Hmm.
Yeah. I remember seeing her in movies when I was a kid, and she epitomised the sort of 60s sex siren or 50s, 60s sex siren. And then
Yeah.
retired young and became an animal rights activist.
Yeah, and said getting famous was the worst thing that ever happened to her. She despised it, despised fame and all of that kind of stuff. Said it was just horrible. Yeah, which I
You-
can
I
kind of
I
understand.
yeah, I guess that. But I saw a letter from Frank Sinatra to who was the guy from Wham? George Michael. Recently came across it in my feeds. And George Michael had said the same thing. He wanted to retire and get away from fame, and it was a burden and all this. And Frank Sinatra just tore him a new one. Frank Sinatra tore him a new one. Yeah, yeah,
Really?
yeah. Like you would have been dreaming about being famous from when you were a little boy, and when you finally attained it, you want to give it up, and you should make it work for you and use it and use Frank Sinatra parlance, make it your rocket to the moon, whatever moon you want, and use it for good and all this. And I thought, yeah, that's probably the better approach to it than giving it up.
Well, he just died young instead.
Hmm.
Hmm.
But who knows? I mean, I'm not talking from experience.
Come on, you're famous in a very small circle.
Yeah, and to be honest, that's been enough for me.
Not enough for
Hmm.
me. I want you to be world famous. The next Warren Buffett. That's what I want. All right.
Uh,
Well, let's go do the US show.
okay.
Thanks, Tony. Thank you for a good year, Tony. Thanks to all the listeners and the members for sticking in for this year, and congratulations to everyone who stuck around this year. I hope your portfolios have all had a great 6 months, and hopefully it continues for a little while longer. But a lot of respect for the people that stuck in there and just kept following the system, and hopefully are now seeing the results and the returns of that.
Yeah, well said. Yeah, it's kind of strange that we're at the end of 2025 already. It's been a quick year as well.
They get quicker.
Hmm.
AI will fix that. Don't you worry. It'll
How's
it'll
AI
make it'll
going?
make it'll make time go slowly again.
Oh, good.
All right.
All
Thank you,
right.
TK.
Thanks.
Have a
Bye.
good week, everyone. Happy New Year.